Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, whether you're active, passive, you've been in the industry for decades, maybe you're an industry insider, this is the exact YouTube show and podcast that has been designed especially for you to keep you up to date with all the latest information, research reports, data sets, and original opinions revolving the multifamily industry, commercial real estate, and the economy. We've got an exciting special guest today on the Gray Report. Paul Fiorilla from the Yardi Matrix is here with us, an industry veteran that has just decades of experience of tracking commercial real estate markets. Love to kind of get his insights, what he's seeing on where the market is, where it's been, where we're going, and again, leveraging his experience so we can make some really good investing decisions going forward. Well, without further ado, let's get into it. All right, welcome back to the Gray Report. I am very excited to have Paul Fiorilla from the Yardi Matrix with us today. Paul, I really appreciate you making the time, being on the show. How are you doing today?
Great, thanks. Appreciate you are asking me to be on the show, and happy to be here.
Absolutely. Well, just a little bit of background on Paul. So Paul has 27 years of experience as a researcher and a writer in the commercial real estate markets. He's previously spent 6 years as vice president of research at Prudential Real Estate Investors, where he oversaw publishing and of outlooks and thought leadership research. Before that, he covered real estate capital markets and CMBS for 12 years at Commercial Mortgage Alert. And then he currently serves as a director of U.S. research at Yardi Matrix. And the Yardi Matrix service provides data critical to professional property managers all over the United States. Paul, before we get into kind of your current role and how we're going to leverage all of your years of experience just tracking CRE markets, first I wanted to ask, what do you think the biggest differences between commercial real estate markets today compared to when you started almost 3 decades ago?
Well, I think one of the big differences is research and the amount of information available. Back in when I started, I started covering capital markets and CMBS, as you just said. And when I started, CMBS was kind of a new thing. I was writing about that. It had only been a product for a few years, and I think over the years, real estate had a reputation back in the day of being something where, guys got together at the country club and did deals on napkins or something like that. And it came out of the savings and loan crisis, and there were all sorts of problems in the industry. And one of the things that really changed was sort of the increased institutional involvement, professionalism of research and data. Back in the 80s, when a lot of these problems, there were a lot of reasons for the S&L crash, and I wasn't in the industry back then. I didn't get into the industry till the mid 90s, but there were a lot of reasons. But one of the reasons was, right now, if somebody does a development, they've got pages and thousands of data sources as to tell them about demand, about supply, about the chances of success. And I think that 30 years ago or so, back when I started, a lot of that information was just starting to become integrated, and it's gotten a lot more integrated over time. Yardi, for example, has databases on, all the major property types except retail. So, I think that's probably the biggest thing.
Yeah, no, just from my experience, you being in the industry, I've been a real estate investor for about 15 years. Really been full time in the commercial real estate industry for a little over 7 years. And just from me getting into the industry, I've seen an improvement in the data and the type of research that is out there. But still compared to public markets and other asset classes, commercial real estate, it's still a little bit of a black hole. I mean, I'm thinking of, cap rates as an example of where there's not and you may hopefully maybe can correct me, but there's a lot of the information resources on cap rate data isn't that great because it's not really public. Sometimes we're using surveys, sometimes the surveys aren't even correct, or sellers or buyers or brokers may give even incorrect data at times. But commercial real estate industry from a data perspective has come a long way. What do we have to do, maybe over the next decade to do a little bit better to make the markets a little bit more efficient and just to have a little bit more transparency on what's going on in the markets?
Well, that's a big question. A big question. With cap rates, first of all, what the right cap rate is an opinion, right? So the cap rate is you have a cash flow, and then what's the proper return on your investment. That changes over time, and it changes not only absolutely in terms of what people's perceptions are, what investors' perceptions are of what is the proper return, but it's based on other products and other, what's the return in the treasury market? What's the return on foreign bonds? What's the return in the stock market? And also what other products are yielding. So there, for example, mezzanine debt and commercial real estate over, again, going back to the times I've been in the industry, that has swung wildly in terms of what is the proper return for a high yield mortgage. And the returns got really thin in 2006 and 7, and then the market crashed, and a lot of that mezzanine debt just blew up and
Yeah.
and turned out to be worthless. And then there's more of a risk premium that the yield went up after that. But then as the market got better again over the last decade, before last year, the returns on mezzanine debt got squeezed again. Lenders were not doing the high leverage that they did in 2006 and 2007. But if you want to compete and you want to actually win business, you have to accept what the returns are. And they got tight. Now they've kind of widened again. But so, what the cap rate depends on market forces, but there's also a lot of different ways to calculate a cap rate.
Yeah.
So different people use different measures of it. That's a very complicated,
That's
and
a tough,
we
yeah,
could
that
have
may
a
be,
whole day talking about this with different people in the industry.
yeah. Yeah. No, one person's cap rate maybe is completely different to someone else, and it's totally a perception issue in time and period. It's not easy. But I am looking forward to the increased depth of just CRE research and data, and it seems like there's been some more nuance and like a deeper level of analysis in the CRE research space that I've noticed over the last several years that I think is very welcome, especially if you're an investor in other asset classes, especially in the public markets, than coming over to CRE. So,
And
yeah,
another aspect of this is that different types of lenders, different ownership groups have different levels of information. So privately owned real estate, there's no public, they don't publicly release all their figures. So a lot of times you have to guess. There are trade groups like NACREIF, the National Council of Real Estate Investment Fiduciaries, that compiles information from, I don't know, 50 or 60 of the biggest private equity funds. And they use that information, they aggregate it, and they create indexes and returns that people in the, investors in the industry can judge themselves against. Or on the debt side, CMBS is totally transparent because all the cash flows, it all gets funneled into servicers and trustees that publish reports. So people in the industry can see that. But banks don't have to provide information about the performance of the loans on their books. So depending on who the investor is, who the lender is, there's more or less information available in the public, to the public in the market at large. And so like REITs, and another thing, like REITs, they have very stringent reporting requirements, and so there's a lot more information about the performance of their properties than there are of most private property owners. Although REITs, a very small part of the overall commercial real estate market. So we have enough information to be able to make some judgments, but we don't have information about everything all the time.
Yeah. Yeah. It seems like there is more information is out there, but it's in kind of different buckets. And sometimes you have to kind of go looking for it, which is one of the reasons why we started the Gray Report and we tried to start aggregating this information. And I know it's also the reason why you all do what you do at Yardi Matrix is to try to put this all, not only gather all the data, but provide some analytics to aggregate it and to put it into a very kind of useful form that is actionable, that investors, brokers, anyone in the industry can actually use. And just so on that, can you tell us just a little bit more about what you do at Yardi Matrix? And then, and maybe just right before that, for those that don't know, I'd be surprised if they're watching this because we use your guys' research all the time. What is Yardi Matrix for those who may be unfamiliar?
Yardi Matrix is the data arm of Yardi Systems. Yardi Systems is probably the biggest provider of property management software in multifamily, and it's also used extensively in other property types as well. And we are the data arm of Yardi Matrix. So about 10 years ago, Yardi Systems bought a multifamily data firm in Scottsdale, and that became Yardi's, the beginning of Yardi's data operation. So Yardi has information, extensive information, all rent, occupancy, development information, loan information on each more than 80,000 multifamily properties, about 20 million apartment units in the United States. We also have a database of student housing properties and single-family rentals. The single-family rental database is fairly new, and it's the biggest database of SFR properties of anyone in the country. We also have the largest provider of data in the self-storage industry. We track 33,000 self-storage properties across the country, and we also have a database, a relatively new database of RV and boat storage, which is an interesting up-and-coming niche sector.
Yeah.
And we have a national database of office and industrial properties, which again, we have all information on the rents and occupancy and all that. And then clients of Matrix use it to underwrite deals, to do market research, for whatever, there's a lot of different purposes that somebody uses the data.
Yeah, so there's a lot of data. There's some other data providers out there. But I guess what sets Yardi Matrix apart from some of those? I mean, just the fact that you're having the direct inputs from the properties, having Yardi Systems, the property management software. I mean, that's a big differentiator. But
right.
What anything else that Yardi's doing that's different?
We have this software. Not all of the information comes from the software. Most of the data that we have is through sort of the traditional research methods of combing through public records, calling the properties. We have teams of hundreds of people that do that, and that's not part of what I do. But so we have that now. Matrix clients also have access to what we call Matrix Expert, which incorporates certain things. For example, expense information, aggregated expense information. So if you were underwriting a property, you were buying a property in Phoenix, and you could look and say, in a 3 or 5 mile radius, what are the expenses of this property versus the average, expense profile of similar properties in the same market. And that is actual information that comes from the software, our clients, and it's, aggregated and anonymized, so you can't, see the individual information of our clients, but it's incorporated into the Matrix product as a tool for users. So there's a mix of most of the information we have, again, is just sort of traditional, and some of it comes from the software. We can also, you look at the information from the software just to, say, is there any difference between what we're getting on, our clients, the actual data, versus, what we're getting in our surveys, and just kind of check to make sure that everything looks right. And as
Yeah.
far as what makes us different, Yardi has a very strong cultural, kind of, our company's culture is to be accurate, to be thorough, and to try and do the right thing in the market. The different companies that do this have different standards, and we kind of feel like, you can get data and look at aggregate data, and the individual, and then when you drill down to an individual property, find this data is old, or
Yeah.
it might not be accurate. We try and make sure that everything is as up to date and as accurate as possible. And as far as what sets us apart, I think that's probably the main thing.
Yeah, I think that's what I think of also, especially when I'm thinking of some of the other, data providers or those that are writing or putting out reports. But sometimes I think about, I guess, the incentive behind some of the groups that would put out a report, and what their end goal is. For example, if there's a group that's either a brokerage firm or a lender, and they're providing research and information, there's some great stuff out there from the brokerage shops and some lenders and other industry groups. But at the end of the day, they're still selling a product. In their cases, they're trying to sell commercial real estate. Whereas when I think of Yardi, certainly you all are in the business of selling the Yardi system and property management software. But at the end of the day, if what you're putting out ends up not to be accurate, really that whole data arm and why people are trusting it kind of goes away. And there's not as a correlated incentive, I would say, between the users of property management software and we want to make the market look as good as possible to encourage buying. So I guess should investors and readers, should they be, I guess, concerned, or what should they kind of keep a lookout for?
Look, everything goes into the credibility of the authors of reports. And I know, like, I've been in the industry a long time. I have a lot of friends in the research world, and I don't know anybody that is purposely, writing spin and not being, trying to be honest. I do think, you mentioned brokers, their business is based on deal flow. It's very rare that you'll see, read a brokerage report that says, this now's a bad time to buy, right?
Yeah,
But
exactly.
I don't want, I don't want to question, the motives of anyone else, but
Yeah.
I do know that, our research, we attempt to try and, give people an accurate depiction of what's happening in the market. And, this is something that is difficult to achieve no matter who you are. If, journalism, whether you're talking about, reading, Bloomberg, the New York Times, Washington Post, anything, industry media, trying to present an accurate picture of, market conditions. It's a tricky thing, and it's something that, throughout my career, not just at Yardi, but my entire career, I've strived to do. And I think our research publications, we do a good job in, painting what we think is the most accurate picture of the market. Certainly, we're never right about anything. We, one of the things that, we didn't predict, what was going to happen with the pandemic, or nobody did. But, one of the things that surprised us was, the recovery, when the pandemic happened, Um, we would have thought it would have taken years for some markets to recover, but then the recovery was a lot quicker than we could have anticipated. But those are the kind of things that when you're doing research and forecasting, nobody has perfect foresight, but we try our best to be accurate and to present as you know, uh, you know, not just accurate, but try and present a picture of the market that comports to what really is happening out there.
Yeah, well, in our opinion, you guys have done a great job. And it, like I mentioned, we use Yardi research and the reports you're putting out very frequently. They're constant features on the Gray report. One, because of the consistency, and one thing I want to mention that you brought up is the addition of the single family rental information that I think it was just this last year that you started including, and that's been such a great data point to look at, because while there's tons of correlation between single family rental space and multifamily rentals, has been interesting to see the difference, especially with the fluctuations in just the single family home market, but also as build to rent has become much more of a popular investment strategy and an asset class in itself. It's interesting to kind of just track, I guess, the convergence of kind of multifamily and single family, and just really single family as an investment asset class, all in its own. I'm really, but for the build to rent space. So you guys are doing a great job, and that's exciting.
Yeah, thanks. I mean, the single family rental market kind of came into being, after the global financial crisis,
Yeah.
when, banks had sort of like back in the 80s with commercial mortgages, the S&L, the savings and loans sold pools of mortgages that were defaulted, commercial mortgages. Well, in 2008, 2009, banks had a lot of single family mortgages that were, um, defaulted, and they sold big pools of them to investors. And the question at the time was, is this a trade, that, you hold these things until the value recovers and then sell them, or was it a long-term business? And there's been, the market had that initial pop where, all these properties were bought by institutions, and it got a second, and then it kind of stayed the same. I'm not saying it didn't grow at all, but it kind of, maintained, it kind of plateaued
Yeah.
at a certain level. And then it picked up again a couple of years ago. Institutions, were looking for something where they could get some extra yield, and multifamily was so much in demand that it was really hard to buy multifamily. The multifamily cap rates dropped really low, and even if you were willing to pay low prices, there was so much competition to buy multifamily product. Properties were put on the market and had dozens of bidders. So some institutions took to the single family rental market as a way that they could actually, put out money and get slightly higher yields. But the issue though is you can't buy them in bulk anymore. Back, if you have to buy property, there aren't massive defaults. So in order to build your portfolio, you have to, buy one property at a time. Now, when you have $1 billion to spend and you're buying a single family house one at a time,
Yeah.
that's
That's
not quite
no
as
one.
simple.
No.
So that's kind of where the build to rent started and became uh, a bigger asset class, because builders are like, hey, this is just, it's inefficient. Maybe the most efficient way we can add to our single family rental portfolios is to build them ourselves
Yeah. Build a
and
whole neighborhood, and
build a whole neighborhood. So um, that is
I think
the fastest growth in that sector, I think, right now.
and it's also, kind of following some demographic shifts also. One, from an investable asset class, that makes a lot of sense, but also, we have millennials, which, of folks of my generation. I'm 35 years old, and so if people around my age, starting to get married, have kids, all this household formation, and kind of getting that stage of life where many are considering, I'd like to go and maybe have it buy a house, or they thought they were going to buy a house, but bottom line, they want some more space. Maybe they want to be out in the suburbs, a yard, have kids, their dog. And we haven't really been building enough housing stock, whether it's single family homes or multifamily housing in the last decade or so. But there is clear with millennials being the second largest, if not the largest, generation, followed or right next to the baby boomers. It's in a way, it's kind of following that demographic trend and the demands for individuals, forming families.
Yeah.
So does that kind of line up as well, in your
Yeah.
opinion?
My you're just a little bit older than my oldest son, right? And my my comment about that, I'm very bullish on long-term demand for single-family rentals because I think people want to live in houses, but I think the younger generation is not as interested as my generation was in owning a house. When I was, in my 20s, the cultural kind of view was, hey, if you were a successful person, you would own a house. If you were in an apartment, you probably weren't that successful. You didn't make enough money or whatever. But just the cultural, way of thinking at the time was, owning a house was, hey, that's just what you do, right? I mean, everyone wants to
Yeah.
own a house. Um, you look at statistics and going back to the 60s, 80 something percent of people in their late 20s were married and had kids, right? So that's kind of a demographic that wants to own a house. Now that is maybe 30% of, the between people between the ages of 25 and 30. And the younger generation, again, I'm speaking in generalities. We're not
Yeah.
everybody, but we're speaking in generalities. But they don't view home ownership as something quite as necessary or appealing. They want the amenities, they want the house, but they're just as happy to rent and not have
Yeah.
to, worry about fixing the roof and mowing the lawn and doing all those other things that that come with ownership. And they also have the flexibility to move when they want and all those kind of things. So uh,
Yeah.
people want single family houses, but whether I think the rental model for them is good. The
Yeah.
the
Do
trick
you need to
for
do they need to own it? Maybe not.
right, and the trick is that the vast majority of SFRs are owned by mom and pop small owners. Can institutions over the long term you know make it worth their while in terms of managing properties that are in different locations, and it's you know there's a lot of companies that are trying to do that, and I think the management of that is improving all the time through technology and data and research. You talk to some of them, and they've kind of said they're getting the management of properties, single family rental properties, down to a science. But it's still not as easy as owning an apartment building where there's 200 units all right next to each other.
Yeah.
So
Yeah.
I think that sector will grow, but it's not, an unmitigated, the growth will come in fits and starts depending on what's going on in the market.
Yeah, I think that makes a lot of sense. And something I was trying to find from just some of the notes that we were trading back and forth was looking for something that you had said about, it's a lot of small changes, they're incremental on the margins, but some of those, incremental and changes on the margins can eventually affecting trends over time. And I'm paraphrasing, you could probably say it much more eloquently than I can, but, I do see those changes, especially culturally, from younger people and the idea of whether they need that desire to own a home and the pursuit of the American dream. And I guess it's making us question, what is the American dream? Is it a 30-year fixed mortgage, or is it that lifestyle of having a single family home? And, it's been proven that, owning a single family home has been a great way to build wealth. It's often an individual's largest investment. But you have to, or we ask ourselves, a lot of times a house can be more of a liability and an asset, and certainly you can make money on it. But if you're going to make one large investment, does that always correlate with, the piece of real estate that you would like you and your family to live in. Sometimes yes, but maybe an investment in another asset class may provide more wealth creation opportunities over time. But that's a lot of cultural baggage that we have to unpack. And just from my anecdotal experience, from myself and talking to people my age plus or minus, there's definitely less of a draw that they need to own a home, but there's still those cultural remnants that are there, that certainly people, if they can, I think there is still a little bit of a status with it. And but every time someone's getting ready to buy a home, because I own a home, but sometimes when my wife and I are thinking about fixing something, the water heater goes out, or we have to do some project and you're spending thousands of dollars, a lot of times I'm thinking, man, renting either a single family home or a nice apartment somewhere seems a lot easier, a lot more efficient, and maybe even like financially a better move. But I think to each their own.
This is kind of funny because just yesterday, an economist friend of mine posted something on LinkedIn about how he was concerned that because the home ownership young generation, the Gen Millennials and Gen Z were not buying homes at the same rate, that was going to affect their ability to save, because home ownership
Mhm.
has been a way for wealth to build wealth. And I commented on his post, and I said, you know the younger generation doesn't have the same bent as I was talking about a few minutes ago toward home ownership. But as far as does that really mean that that they're not going to be able to build the same wealth? Maybe, but I think bigger factors are, you know, how much money do you make in your job and how do you invest that money?
Yeah.
So if you have a good job and you're able to save and you invest in, something reasonable, put it in a mutual fund or something, your wealth is going to go up, whether you own a home or not. And, you know, whether your wealth goes up based on a home. I mean, look, historically, the data is pretty clear that, home prices tend to go up over time. So you do. But at the same time, it depends on, where and when you bought a house. My first house I bought in 1988, it was kind of a market peak. The market, after that hit a decline, and, house prices kind of leveled off, and eventually they went up again. But if I had sold that house 5 7 years later, I wouldn't have made any money on it. I was there
Yeah.
for 15 years, so after 15 years it had appreciated. But it's a timing thing and a location thing. So yeah, it's
It's
interesting.
it is interesting, and there are still those social pressures out there, and I think there's honestly the bigger driver than anything of you see the peer pressure or the keeping up with the Joneses, and someone buys a house and, well, don't we want to buy a house, and that's the next thing to do, and then influence from parents of, hey, are you going to buy a house? But it is going to be interesting, and we've been interviewing and asking some of I guess the Gen Z folks that work here at Gray Capital, and just some other acquaintances, just on what their perception of owning a home. And it is interesting. I think a lot of it is just a lot of, especially the Gen Z generation, doesn't believe they'll ever have the ability to afford a home. And so I think some of them are just writing it off, and that they would if they could, but looking at where interest rates are, the cost of housing, and what they perceive as their prospects, I think they're just a little pessimistic on the fact that it may even be a possibility. So, well, I want to shift a little bit just to the market, because there's a couple of things I want to get to kind of before we run out of time. And so this is a little bit big picture, but 2021, second half of 2020 through 2021, incredible performance, especially in the multifamily sector. We've seen an incredible slowdown starting the second half of 2022. I mean, absorption is at decade low levels. Kind of have to go back to 2009 to find a point where we had absorption so slow. Rent growth has gone negative the last few months. Can you tell us a little bit about how we went from just incredible household formation, rent growth, to then just bottoming out in terms of absorption and demand within really a couple month period. And obviously, there's a lot that's happened over the last 18 months. But if you could give us just a little kind of snapshot.
Yeah, I'm not sure I see it as bottoming, but let me just go back a little bit, right?
Yeah.
So, we had, after the financial crisis, we had a very nice recovery in commercial real estate and multifamily in particular. Rent growth, and we saw starting in around 2013, 2014, rent growth was above the long term, 2.5, 2.7% average annual growth. And it popped to about 5% in 2017. But it was, we had a good run. And then, of course, a very steady, right, economic growth. We had not too high, not too low, the kind of Goldilocks, 2% growth every year. And things were kind of humming smoothly. Then, of course, the pandemic hit and there were lockdowns. And what we saw with multifamily was that uh, there was a big migration from some of the downtown areas in the gateway markets, particularly New York, San Francisco, and Chicago, where a lot of people left, and they went to markets that were less expensive. 22 million people lost jobs, and so some of it was just, hey, I'm not making any money, so I've got to find somewhere less expensive to live. Some of it was just, hey, I don't have to go to the office, so I'm going to go hang out in Florida or something
Yeah.
like that. And so you had this big migration. So there was, for a few months, kind of the market was kind of frozen, rent growth kind of stopped. And in but the demand remained strong, say, across the Sun Belt and some of the Western markets that continued to, where people were going to, and, that didn't have the, kind of shutdowns that they had in the big cities. And then in 2020, right, so I think I alluded to this before, when the occupancy rate in, markets down 10, 15%, it's like, wow, it's going to take them a long time to recover. But starting in 2021, the demand just became very strong across the entire country. We had, it continued to be really strong, migration to, the Southeast, the Southwest continued, and population growth in places like Florida and Texas and Arizona continued to be very strong. But at the same time, demand returned to the gateway markets, and rent growth kind of took off. And in 2021, our numbers show almost 600,000 apartment units were absorbed, which is by far the highest on record. Rent growth, asking rents nationally rose just about 15% on average, and they were, even more. They were 20% in a lot of places. Miami, Orlando, some of the Texas markets, and it was by far the most the best amount of rent growth. The occupancy levels went up. We hit a record high occupancy level of stabilized properties at 96.2%. And that continued into 2022 for a little bit. It's slowed down, and then it really began to decelerate in the second half of 22. So,
Hey, Paul, just real quick, so I'm just remembering those times when you were coming out with some of that information, especially in 2021, in the, really in July and August when things were really peaking. Would people even believe you when you told them at first, hey, rent growth, for a certain market is, 20%, 30%? Were you having people having a hard time actually
when we first,
believing that at first?
when the numbers really started to pop, was in probably the second quarter of 2021. We get a monthly report when we have a monthly publication
Yeah.
that goes, monthly rent growth in the top 30 metros and national rent. And our data team sends us a spreadsheet with all the numbers on it that, that are, incorporated in the report. And when the numbers first started to pop and we first started to see like double-digit percentage rent growth, I was like, is this right? Let's we have to double check this, and we double
Yeah.
check. Yeah, it's all right.
Yeah. Yeah.
So
I
yeah,
just
I
had
mean,
to, I just had to
it's
ask because
kind of hard
at
to
the
believe
time.
because
Yeah.
there's no historical precedent for it, right?
Yeah.
Rent growth, when it was really, really strong, was 5%. In some markets would go over that, but on a national level, 5-6% would have been wow. It's really, really on
Yeah.
fire. And then when you get up into double digits, it's you have to you've never seen it before, so you have to wrap your mind around it. And when it was first happening, the I think that most people were looking at migration, and because the markets that were doing the best were the ones where there was still ongoing migration, people moving there. But at the same time, the markets that were losing population, that were there was a lot of out migration from, they were also recovering, and rents were turning around there. And it became apparent that what was happening was it was more than just a migration story. It was also a household formation story. So coming out of the pandemic, uh, after we were down 22 million jobs, we started the job recovery. So people started getting jobs back. Wage growth was unusually strong. So companies were having a hard time finding workers. So they had to increase salaries, especially in low wage jobs, retail, hospitality, jobs that suddenly they couldn't really fill at $8-9 an hour more. I know I see Target now just announced that they're going to have everyone's going to be making $24 an hour.
Wow.
Walmart, I think I read a story saying they're going to start their minimum pay is going to be like $17 an hour. Meanwhile, states are debating, oh, do I raise the minimum wage to $11-12 an hour? Well,
Looks like
there's so
Walmart's
much
already doing
demand
it.
for there's so much demand for workers that but the point is that wage growth put money in people's pockets. Plus, you had government stimulus, and people had saved money during the pandemic because those people who were working, they were making money, but they had nowhere to spend it. So,
Yeah.
so the savings rate popped up to like 15%. And so household balance sheets were really strong. We had, I think Moody's estimated something like $2.7 million of additional savings between the first quarter of 2020 and sometime in 2022. So people had money to spend on apartments. So what did they do? One of the things they did was they went out and they created new households. People moved away from the younger people in their 20s and 30s, moved out of their parents' house, moved into an apartment. People who were in roommate situations, living in, with multiple roommates, they were able to go out and move on their own because their financial situation had brightened. So that contributed all these things contributed to uh, a surge in demand. And now that surge, that pent up demand that came through, after the pandemic, is slowing down. I haven't seen any numbers in our data that would indicate to me that it's negative. Now, rent growth has started to turn negative, but just a little bit, not,
Yeah.
and I would suspect that rents are going to be flat or slightly negative for the next few months until we get to the spring lease up season. But our forecast for the year is that nationally rents are going to grow 3.1%, and most of the major metros are going to see 2 to 4% rent growth. It for their The wild card is the economy, obviously. So
Yeah.
you know we talked about the wage growth and people buying things, and that contributed to the surge in inflation, which caused the Federal Reserve to raise interest rates in an attempt to slow down the economy, push up unemployment, to cool the labor market, and all those things that we've been talking about. So inflation
So
has come
yeah.
down. If just real quick,
Yeah.
if we have a soft landing, as we would expect, our forecast is for kind of a soft landing, recession in the second half of the year. We could probably get away with this, and have not too much demand, harm to multifamily demand or demand for other types of real estate. If the economy hits, a rough patch and growth is, negative to any significant degree, then that will have a bigger impact on multifamily, and that might cause our forecast to, you know, it may cause what happens to be a little bit worse than our forecast.
And so, and I was just going to get to the most latest report from Yardi, the winter 2023 multifamily report, and the headline is multifamily outlook hopeful amid volatile economy. And from what I took from the report and others, and just kind of recent reporting, is that it looks like there's a window to return to normalcy, that we're in a period of kind of almost rectification. The pendulum swung one way, now it's swinging the other to try to balance us out just a little bit. And with sounds like a soft landing that you all are all predicting that could facilitate that, I guess, new sense of normalcy. I guess, is that the conclusion, that we're going to kind of get back to a standard 3% average rent growth? I mean, that was kind of the standard assumption for the last decade. Do we see that we're going to get back to a standard 3% over the next decade, or do we see a little bit, I guess, higher rate of growth with a little bit higher inflation?
Yeah, I'm not forecasting, a decade out. That's a little
Yeah.
bit hard, but I do think that what we're likely to see is kind of a soft landing, as opposed to like a 2008 type crash. And there's a bunch of reasons that I think that. Number one is, right now unemployment is 3.5%. Right. Well, let's assume that we're going to see some increase in that, and some kind of softening of the job market and wages. It's still, there would have to be a
We've got some room.
significant, if, let's say, unemployment goes up to 4.5%, by historical standards, I mean, it's not good that people are going to lose jobs, but by historical standards, it's still a pretty solid
Yeah.
unemployment rate. Same thing, on the multifamily level, right? So right now, over the last year, I mentioned, that occupancies had gone down. So they went from like 96 nationally, they went from like 96.2% to 95.4% in late into 2022. That sounds bad, but 95.4% historically is a pretty decent. So we're coming, again, big picture is that even if we see a little more softening, by historical standards, it's not terrible. Rent growth is obviously a problem. The affordability of apartments has kind of gone down. A greater number of households are paying more than 30% for their income on rent, which is kind of the traditional standard of, being house, having, kind of a housing poor, being affordability problem. And so the ability to keep raising rents is going to be diminished, because people are stretched to what they can afford. But I don't see, again, that there's going to be enough of an increase in vacancies, that there's going to be, the economy is going to have enough of a downturn to create kind of a hard landing, a 2008 type, housing crash.
Yeah. Yeah, because we'd have to go through quite a bit of household, just negative household growth and
Right.
house
And I
destruction.
mentioned,
Really to,
that, people had savings, that they don't have 2.7 trillion, it's probably closer to 1 trillion now. So that number is decelerating, and eventually that might run out. But there's still $1 trillion of excess savings, sloshing around, that will help prevent a hard landing.
Paul, I think we may have gone this entire conversation, I could be incorrect, without really talking about interest rates that much. And I feel like every conversation has always been about interest rates.
Yeah.
I don't know how we've gotten around it, but I want to get your your thoughts on, this idea that, there's been a lot of, short term, a lot of bridge loans that were originated in kind of the last year, so last 18 months. Almost all have, are floating rate terms. And a lot of those are going to be coming to term over the next another 18 months, really kind of 12 to 18 months. The concern is with cap rates up and NOIs kind of dragging along with increased expenses, is that the valuations are not going to pencil, and there are going to be some owners that are going to be relatively underwater, and they either are going to have to bring some capital to the table to close, or they're going to possibly enter foreclosure. How concerned are you with that? And let's say it is an issue. I'm just curious of playing it out, of how accommodating the banks may be, because we saw a lot of accommodation during the pandemic with single family homeowners, with a lot of forbearance. Do you see the banks being flexible? Just talk about the situation we may be seeing in the next, year or so, or is it not to do about nothing, and it may not even be an issue?
Okay, there's a lot of questions in there.
Yes.
Hopefully I'll get to all of them,
Yeah.
but so yes, there will be an increase in delinquencies, and you identified, some of the major issues. So in 2020, 21, borrowers were largely taking out floating rate loans. They were taking advantage of like super low rates, and interest rate caps were cheap. And they were thinking, oh, in a couple of years, I'll refinance for even more money. I'll take even more money out of the property because, income's going up so much. That was kind of thinking. And in 2021, there was a record $45 billion of CLOs, collateralized loan obligations, form of CMBS, originated or issued. And most of the CMBS that it was issued, or a lot of the CMBS that was issued, was floating rate. So you had a lot of that short-term debt taken out at very low interest rates, like 3%. And that those loans are starting to come due now, and the prevailing interest rate is 5-6%. It was even 6%. The rates have come down a little bit in the last month or so, so it's maybe less of now we're in the fives instead of the sixes. But still, if you had a property, and I wrote something about this a few months ago, and I took a property that had a $10 million property that had a $7 million loan on it. If you refinance that loan, let's say the $7 million existing loan is 3%, and you refinance that at 6% and keep the monthly payments the same, that same property would qualify for 4.9 million. So you've got like a 2.1 million, kind of gap to finance that you have to come up with somewhere. Now that's just an example, but you can kind of see what the situation was.
Yeah.
Now, same kind of thing happened after the global financial crisis. A lot of properties, there was what everybody called, the extend and pretend, and the banks just didn't want to have defaults, so they just let borrowers make payments and didn't do anything. As far as the question of what banks are going to do, just from my understanding, talking to people in the banking world, is that banks are going to work with borrowers to the extent that they can, but they're not going to do it for free.
Yeah.
So, going back, to the last crisis where, banks let borrowers, drag out the payments. I think banks are willing to work with them, but they want something in exchange, more reserves, more, terms of some type, with some extra equity, thrown in. They want something, they want, the balances paid down to some extent. So, but there definitely will be an increase in delinquencies. And, right now, the default rate on multifamily is extraordinarily low. If we, CMBS delinquencies on multifamily, something like 2%, 1.92%, something like that. And for the GSEs, for life companies, it's like less than a quarter of a percentage point. So let's assume that we're going to see some pop in delinquencies. I still think that that we're far from kind of a crisis, kind of like we had in the last downturn.
Yeah, I can see it being more the perception than the reality of, I can see some, and we've already seen a couple large portfolios that are in distress, that are delinquent, and along with, the redemptions in some of the large privately traded REITs. But, some of those stories get the headlines and people talk about it, even though it's maybe not the whole story. But I imagine we're going to continue to see
Yeah,
those happen over the next year or so.
right. So there are, I read about one portfolio the other day, which was an office portfolio, not a multifamily, but they have a payment problem because, again, they refinanced at a low level, and office is a little harder to refinance because banks aren't really looking to put new office loans on their books right now.
Yeah.
So there are property types that have bigger, office and retail in particular, are have and even to some extent hotels are going to have a hard time refinancing. If we're just talking about multifamily, that's in a better position. Another thing is that old multifamily loans that were originated, let's say you got a 5, 7, 10-year loan coming due. Um, those loans have the benefit of all that rent growth that we've seen
Yeah.
over the last decade. So that gives them a little bit of an extra cushion to kind of make up for, the higher rate. So I think, except in extreme circumstances, there are submarkets, although, largely multifamily is still doing well. There are some submarkets, there are some areas, some properties that, that are performing poorly. Um, so, those are the properties I think that are going to be affected. But, most properties should be able to get through this. The vast majority of properties, I think, should be able to get through this without resorting to, default.
Yeah. So you mentioned some other CRE asset classes, just some of the other food groups, and just real quick before we close out, you had a recent piece on self storage. Self storage operators optimistic despite headwinds. I've always considered, I'm not an expert in self storage, and but one thing I've always heard about self storage is that it's a very recession resistant asset class. It does relatively well in a variety of different types of economies because as you have expansions, people are buying more stuff, need more space. In economic retractions, I've had to downsize. I need to put my stuff somewhere. But I guess give us maybe a brief oversight on, I guess, how the self storage market is performing and a little bit of an outlook.
Yeah, self storage market industry has been one of the the real estate sectors that has performed the best over the last few years. And you know, going back to, I don't know, 20 years or so, if you look at the public market, self storage REITs have outperformed every other asset class over a long period of time, and it's not even close. The industry was obviously the pandemic was a big thing, and for every asset class, and there were some benefits to self storage. So one of the drivers of demand for self storage was work from home. People started, they created need to store, office people, home office things, and people had to move furniture out, create offices at home. More businesses who have trouble getting industrial space, using self storage.
Hmm.
The percentage of households that use self storage has consistently increased over time, and it took a bit of a jump as well in 2021. So the self storage street rates, which asking rates, jumped, you know, 15%, at the peak during, 2021, 2022. Street rates have started to come down, but, the income of self-storage operators continues to be strong because they um, are raising rates on existing customers. People are staying longer as an average. So, the average self-storage, might have been 12 to 18 months. And now that number is creeping up to 18 to 24 months. So each additional month, when you have a short-term thing like that, each additional month, kind of creates more demand. So occupancy rates, net NOIs of self-storage properties have been very strong. The operators expect this year to be not quite as good as the last 2 years, but they're expecting, you know, 6 to 10%, revenue growth this year.
And the other thing that I've learned about self storage is that it's a very I guess balkanized industry where still most of the ownership, at least recently, has been largely mom and pop individual owners. And there hasn't been a lot of consolidation, but I've seen more and more, I guess, consolidation stories or self storage funds, consolidating portfolios with self storage. Do you see that changing the asset class at all? And I guess, do you see that trend continuing?
Yeah, because yes, the REITs and large institutions, um, have been, it's a long-term thing. They've been rolling up smaller properties for a long time, and it's a big industry, so they will continue to do that. And I think when I mentioned that REIT returns for self-storage were so
Yeah.
good, I think investors looking at that, saying, "Hey,
Why
we
aren't I
want
investing in
some
self
of, why
storage?
aren't I doing that?" And
Yeah.
one of the drawbacks to institutional investment in the sector was that it's hard to spend a lot of money, right? Each individual self-storage
Exactly. Yeah. They're
property.
all
If you've got
couple
a
million
billion
bucks.
dollar fund, you're going to buy $5 million properties. That's not terribly efficient or glamorous or anything like that. But I think that the returns and sort of the competition when you're trying to buy you know, office, industrial, and multifamily, which are the two sectors that everybody wants to be in. It's hard to. It's You have to pay a high price in those sectors, and you've got a lot of competition. So that drives some of that into self storage. Another area I mentioned, we had an RV and boat sector
Yeah.
um, database. That's even like a small subset of self storage, and there's a lot of demand for RV and boat storage. RV sales, motorboat sales, over the last couple of years have hit record highs, and they're near record highs. A lot of homeowner associations don't allow you to store them on your properties. A lot of people don't have the space to store them on their properties, even if they could. So they need, there's 6 million RV or 6 million motorboats, or so you got 6 million RVs and a couple million motorboats in America that are registered. They need, a lot of them need to be stored. There just aren't a lot of places to store them, and there are only a couple of, in our database we track more than 1,000 properties, and only a very, very tiny percentage of them are owned by anybody that owns more than one or two.
Really.
95% of them or more are owned by somebody that just owns one or two of them. And I think that's a sector where there's a lot of opportunity to create, kind of an institutional ownership, to, branding, and to roll up a lot of properties. I think that's something we'll see in the next few years. It's, still in the early stages, but it's definitely an opportunity there, in my opinion.
I think that makes a lot of sense. Kind of getting back to some of those just demographic trends of the baby boomer generation and millennials. The baby boomers are retiring, getting that RV or a boat, and millennials, whether it's van life or you go on to fishing, having kids, want to take the kids out skiing or whatever, getting into peak
Yeah.
earning years. I think it makes a lot of sense, and definitely just a personal anecdote. I've thought about maybe buying like like a bass boat or something, but I'm like, but where am I going to? The question is, where am I going to store
Yeah.
it?
People drive
So
hours to store these things, and then when they store them, then the question is, are there facilities available? Some facilities are just like big parking lots. Some of them
yeah,
have a canopy, and some of them, there's a growing number of indoor climate controlled storage
Yeah.
spaces, because people don't want these boats and RVs cost, they can cost hundreds of thousands of dollars. People spend a lot of money on them. They don't want them sitting out, deteriorating because of the weather. So
Yeah.
that's part of the opportunity, not just to own facilities, but to create kind of higher level facilities that have more services. And the that's where an institutional owner could come in and kind of add value.
Yeah. It's exciting. It's exciting games. I've got a bunch of anecdotes where that makes sense. My mom lives in Tucson, Arizona, has an RV, and she's like she's begging for. There's one RV service center and storage. It's air conditioned. They have the full service. They'll take care of your RV. You drop in, you pick it up. But she's like, there needs to be one on. Yeah, I think whether it's the south side of Tucson or the other side of Tucson, just knowing that it would do so well. So I think the anecdotes are lining up with the data, and that's really exciting. Well, Paul, we've kept you. We're over time. We've kept you really long. You've been really patient with us. These have been
Yeah,
some
we
really
didn't even
great
get to some
insights.
of the things we were going to talk about, but that's
I know. All I could think of is that we're gonna have to have you back on it sometime soon, because we could go into just a lot more detail on some of these topics, and then there's areas we didn't even get to. But I thought it was a great conversation, and so thank you again for coming on, and thank you for all the work that you're doing over at Yardi Matrix and the whole Yardi Matrix team. Because again, we really appreciate the research that you are all doing, and we are following it very closely. And if you ever wondered if you're appreciated and who's reading these reports, we are doing it. And again, it's really great work that you're all doing.
Thanks. I appreciate the compliment, and
Absolutely.
happy to talk to you, and happy to come back sometime and do it again.
Wonderful. Well, before we go, Paul, if you'd like for people to get in touch with you, what's a good way for them to do that, or with Yardi Matrix? Yeah, what's a
So
good way
you
to get?
can read our publications at yardimatrix.com/publications. We have a blog, yardimatrix.com/blog. And you can email me at paul.fiorilla@yardi.com. And so I'm happy to, if you read any of our publications, my name, if you want to spell my name, all my contact information is on the website. It's on the publications. And yeah, I always love to hear from readers and to get feedback.
Wonderful. All right, Paul Fiorilla from Yardi Matrix. Thank you again. Have a great rest of your day, and thanks everyone for watching the Gray Report.